this is the situation where the 40% of managed money that's in fixed income or basically sovereign bonds globally, a portion of that goes into crypto. And so you have a massive amount of fiat that can only go through a very, very small door. You just get insane price appreciation across the whole space. I don't think people appreciate that right now. They're like, oh, is Bitcoin at 70,000? Maybe I should take some out the table. No, you shouldn't. This is a time, if this is the narrative that you were operating under when Bitcoin was 16,000, we haven't even gotten to that point yet. We've just started. This is just like the amuse bouche. It's not even the entree yet. So we're just getting started in this thesis of the collapse in terms of we have this one asset that's real. We have this whole fugazi financial system. For the first time in history, we have an ability to express a put option on these bonds in an easy digital fashion versus, going out and holding a vault of gold, which is quite difficult.
The world financial scene had several difficulties towards the end of 2023, especially in the cryptocurrency industry. Former BitMEX CEO Arthur Hayes became a prominent critic, alerting people to the possible unintended consequences of central bank policies and the mounting national debt. Hayes contends that additional volatility may result from the Federal Reserve's ongoing attempts to control inflation through changes in interest rates and liquidity infusions. One of his most important observations is about Bitcoin's place in this unpredictability. Although the supply of Bitcoin is still restricted and mostly owned by long-term investors, institutional heavyweights like BlackRock and Fidelity are increasing their positions in the cryptocurrency. Hayes believes this might be the catalyst for Bitcoin's explosive growth. But he issues a warning. If institutional demand decreases, the market might face a severe drop. If you're enjoying this content, be sure to like, subscribe, and turn on notifications to stay updated. Don't forget to check out our other videos on cryptocurrencies and finance. Now, let's hear his following words.
You have this thing where interest rates on the debt was rising, but at the long end, it was rising faster. So post the September Fed meeting, the spread between the 10-year bond and the 2-year bond was increasing, meaning the 10-year yield is rising faster than the 2-year yield. And in general, both are right. The yields are both rising at the same time, which is basically called a bear steepener in fixed income trading terms. And that is deadly for banks and the entire financial system, because the entire financial system is modeled post sort of 1970s, 80s on this assumption that when back-end interest rates rise too quickly, that the authorities will come in and print money to save the system. Now, they did do it, so the market got it right. But in the meantime, all these financial institutions, in the way that their complex financial derivatives are structured, ignore this particular quadrant of the potential outcomes and thus have massive losses. And this is what we were seeing across the banking system. So if you looked at the regional bank stock index or KBW index, which is all U.S. banks, they're getting crushed going into late October of last year. And so what happened? The U.S. Treasury and Janet Yellen, she said, okay, I'm going to save this market. I'm going to issue a bunch of short-term debt and take money out of the reverse repo program at the Fed, which is just this $2 trillion facility of cash just sitting there that's outside of the financial system. And she offered a higher rate on short-term treasury bills to entice this money out, and which reflates the system, gives more credit money into the system. And that sort of helped, fuel this bull run that started essentially on November 1st of 2023. So we're going to get another event like that, because if the Fed, the Treasury, and their other global central banks and fiscal governments, if they continue to do what they're doing, but say that on the one hand, we want to try to fight inflation by not printing money, we're going to get another situation like we got in the third quarter of last year, where the bond market says, hold on a second, what do you want to do? Do you want to safeguard the value of fiat currency, or do you want to make sure that the government is funded? And I don't know when that situation is going to happen. There's lots of tricks that they can pull, probably a little bit too mundane for this particular venue, if you really want to get into U.S. money markets. But there's going to be another situation like that. And you could see a general, risk off, meaning financial assets decline on that situation, on the fear that maybe this time they're not going to save the banks and print the money and reflate the system. I don't think that's going to happen. I think they'll do the same thing they've done every single other time. But you could get a situation like that. But if I have to really think about what could stop this particular bull market, it's going to be something about the belief of institutions buying Bitcoin. So what's the narrative right now? You never sell because the institutions like BlackRock and Fidelity, they have to buy all this Bitcoin because there's all this pent up demand from institutions who want to incorporate Bitcoin into their portfolios. And there's all these diamond hands out there who aren't going to sell their Bitcoin. So there's a very low supply of Bitcoin left to sell, which means the price goes asymptotic on the upside. Now, obviously, that can be true for a while, but it won't be true forever. And so at the point in time where we start to see a massive leveling off of the allocations of money into these products, then that narrative starts to shift. And people can become less confident that there will be a few $100 million of buying of Bitcoin every day from all these major ETF fund managers. And I think that might be the thing that I'll be looking for, which says, okay, whatever the price of Bitcoin is at that point, maybe it's time that I think about, at least for the other non-Bitcoin and Ethereum assets, getting out of all of those, right? And I have a very big venture capital portfolio of early stage crypto tokens that will need to be liquidated. And then on a more philosophical level, I'll have to think about, well, if Bitcoin has risen to such a high level relative to the energy that it represents, maybe I should own a power plant or a massive stake in ExxonMobil or something where I actually own the fundamental energy source and I got it at a very cheap price relative to the price of Bitcoin. And that's a way that I can take some chips off the table in Bitcoin terms. But what I probably won't be doing is selling Bitcoin or Ethereum for fiat, because I still think that the fiat system is, and I don't want to participate in that. But primary energy, if I can own those resources at a very attractive price because Bitcoin and Ethereum and these other assets have been bid up to such an insane level, then that's probably something I should be doing.
Arthur Hayes believes we're getting close to a tipping point where the sheer weight of their commitments could cause major sovereign debt markets to collapse. According to him, governments would soon have no choice but to acknowledge that they cannot continue to spend at their current rates without creating a lot of new money. Hayes thinks that when governments and central banks give up on trying to continue implementing effective monetary policies, this understanding will be a crucial turning point. Bond markets would be severely impacted. According to Hayes, bond investors have already suffered large losses over the last 3 years, and the returns on U.S. Treasury bonds have been the lowest since the War of 1812. According to Hayes, when more investors become aware of how unsustainable the present system is, they will turn to alternative assets like Bitcoin for security. That being said, let us return to Hayes' words.
It's a put option on government bond market. And so I think we're at the point where the largest government bond market admits that we can't afford this, so we're just going to print the money anyways. And that's the option that you're really trading on Bitcoin. You want to be around for that, because that's going to be, and if it happens this cycle, it's going to be absolutely insane. And so that's when I'm running an essay right now, and the tenet of the essay is people don't have enough imagination about how ridiculous this bull market can get. So if we combine the Bitcoin is now available from a financial perspective to be ingested into TradFi portfolios, and you have TradFi portfolios do not want to own bonds because everybody knows that this is what's going to happen in the treasury market and JGB market, ECB's bonds, China bonds, all the different bond markets. If these confluence of factors, this is the situation where the 40% of managed money that's in fixed income or basically sovereign bonds globally, a portion of that goes into crypto. And so you have a massive amount of fiat that can only go through a very, very small door. You just get insane price appreciation across the whole space. I don't think people appreciate that right now. They're like, oh, is Bitcoin at 70,000? Maybe I should take some out the table. No, you shouldn't. This is a time, if this is the narrative that you were operating under when Bitcoin was 16,000, we haven't even gotten to that point yet. We've just started. This is just like the amuse-bouche. It's not even the entree yet. So we're just getting started in this thesis of the collapse in terms of we have this one asset that's real. We have this whole fugazi financial system. For the first time in history, we have an ability to express a put option on these bonds in an easy digital fashion versus going out and holding a vault of gold, which is quite difficult. So that is the insane bull market thesis that I've been operating under. We're marching towards that. I don't want to be underallocated if I'm right. If I'm wrong, we get, maybe Bitcoin goes to 100,000, 200,000, whatever it is. And okay, cool. Made a good chunk of money. We'll prepare for the next cycle because it's coming. If it's not in the 2025, 2027 timeframe, it'll be when there's the global world war of the end of the decade or a little bit after, as we've come to this situation where every government's printing money because they're going to war with each other. So that's the trade. It only is going to happen once. He's got to be around for it. I think this cycle is a cycle where we break the sovereign debt markets, where every single major country finally admits that we will do anything it takes to make sure that the government does not go bankrupt. And so we're going to remove all this pretense about caring about sound money, and we're just going to start printing money like it's going out of style. And so I think this cycle is going to be a bit different than the last cycle, where the Fed and then every other central bank said, oh, we've overdone it. Let's try to reduce it. They tried, but the governments are still printing money because they need to get reelected, and we're in an inflationary environment. There's too many old people. Everyone's going to go to war at some point, so everyone's beefing up on defense. And so the central banks have come back in and said, okay, we got to print money, but we can't really call it quantitative easing or the things that we called it before, so we'll make up new names for it. But it's the same thing. And so we want to protect the government bond market and make sure the government can continue to borrow at below the economic growth that they're creating. And so I think right now we're in this cycle where people are realizing this, and you have the professional investor class are also realizing it because they've had the worst bond performance, at least in the United States, since the War of 1812. Over the last 3 years, U.S. Treasuries, 30-year Treasury is down 50% on a real basis. That is the worst return since 1812. Now, you wouldn't know that by listening to the financial press, but bond investors are getting absolutely eviscerated. And as they come to the realization that this is not good, maybe we should own something else, that's sort of this secular rise and sort of Bitcoin. So I don't think it's going to be a similar type of credit event that's going to prick the bubble and crypto and everything else that happened in 2021. But there's going to be some change in that mindset, and that's what I'm looking for. And there's no real one thing you can point to. It's kind of just be cognizant of the fact of, why do you think the market's going up? Is there something that's happening that's challenging that worldview?
Global financial markets, particularly the bond markets, are undergoing a significant chaos, according to Arthur Hayes. According to him, there will come a time when big countries would give up on any pretense of prudent financial management and acknowledge that they can't continue to print money in order to pay down their debt. This is a significant turning point, according to Hayes, especially for Bitcoin, which he refers to as a put option on the government bond market. To put it another way, Hayes is arguing that Bitcoin provides a means of hedging against the potential collapse of established financial systems, such as the bond market. More money will go into Bitcoin as institutional investors realize that government debt is unsustainable. Given the trend of traditional financial portfolios shifting away from bonds and toward assets like Bitcoin, this might trigger an explosive bull run in Bitcoin. What does all of this mean then? Hayes believes that as governments begin creating money on a never-before-seen scale, Bitcoin will emerge as the preferred asset, and we are on the cusp of a historic financial revolution. This is about positioning yourself for the long-term, possibly once-in-a-lifetime Bitcoin bull market, not just about making quick money. This is the perfect time to start observing this pattern if you haven't already. Make sure to hit the like button, subscribe for future updates, and enable notifications so you don't miss our upcoming video on navigating this changing financial world. Until next time, happy investing.